The cultural image of the stock market is built on the myth of the superstar trader. We picture a high-skill, adrenaline-fueled profession where experts relentlessly outmaneuver the crowd to beat the market. In reality, investing comes down to two distinct approaches. An active investor selects individual stocks in an attempt to outperform a benchmark, while a passive investor simply buys a fund that tracks the benchmark itself. When we measure those two strategies against each other, the myth of the superstar trader collapses. According to 20-year data from the SPIVA scorecard, 79% of large-cap active fund managers failed to beat their unmanaged index benchmarks. Even when you compress the timeline to 10 years, the picture barely improves. A mere 21% of these active managers managed to survive and outpace their passive equivalents. For long-term investors, the expert advantage heavily portrayed in financial culture is largely a statistical illusion. On Wall Street, sheer effort simply does not equal sustained outperformance. The reason these professionals struggle to beat the market often has less to do with a lack of skill and more to do with the total expense ratio. This is the annual fee deducted directly from your assets, meaning active managers must clear this structural hurdle before they generate a single dollar of actual profit. This creates a phenomenon known as invisible compounding. Over a 20-year timeline, a seemingly insignificant annual fee of 2% quietly consumes a massive portion of an investor's total returns. Global regulatory bodies are targeting this hidden drain on wealth and stepping in to force transparency. Look at the 2026 mutual fund rules implemented by the Securities and Exchange Board of India. They strip away the illusion of bundled costs, forcing active funds to isolate their pure management fees from external brokerage charges and statutory taxes. Once the true costs are exposed, the math is undeniable. Active managers are often failing simply because their exorbitant fee structures place them too far behind the starting line to ever catch up. Acknowledging this mathematical reality, investors are triggering a massive capital flight. They are abandoning expensive mutual funds and pouring their money directly into cheap, passive exchange-traded funds. This migration has crossed a critical threshold. Passive investing strategies now account for a staggering 50% of the total equity market. But the passive index has a mechanical flaw. It buys stocks blindly, based entirely on a company's market weight, completely ignoring fundamental value, revenue growth, or the underlying health of the business. Recent findings from the European Central Bank and the Apollo Academy reveal that this automated blind buying severely reduces market liquidity and price elasticity. To minimize tracking errors, passive funds avoid trading during the day and instead overwhelm the closing auctions in the final moments of trading. This structural habit artificially warps stock prices. This momentum-driven buying cycle forces money into the largest companies, creating a dangerous concentration of power. It hyperinflates the valuations of a few mega-cap tech companies, the group known as the Magnificent Seven. Passive investing successfully solved the fee problem for the individual, but its sheer scale has broken the market's basic ability to accurately price assets. The stock market is increasingly operating as a fragile momentum engine. Despite this shift, there are isolated market conditions where the rigid, mechanical nature of passive indexing actually works against the investor. This chart shows the 10-year success rate of active funds in beating their passive peers. Notice the spikes in foreign and diversified emerging markets. In these inefficient, poorly covered environments, active managers consistently find mispriced assets and beat the index. To separate true stock pickers from expensive closet indexers who secretly just mirror the S&P 500, professionals use a metric called active share. It reveals how much a manager's portfolio actually differs from the benchmark. Genuine active management also provides something an automated index cannot: vital downside protection during market crashes. This defensive capability is measured by the Sortino ratio. It evaluates a manager's ability to limit losses during market downturns without penalizing them for upside volatility. For highly efficient large-cap stocks, active management is mathematically unviable. But for navigating volatile global sectors, it remains a required defensive tool. To navigate these extremes, modern investors use an architectural framework known as the core satellite portfolio. It combines the cost efficiency of the index with the tactical advantages of active management. The core represents 60 to 80% of the capital, allocated strictly to low-cost, broad-market index funds to capture steady market returns. The satellites make up the remaining 20 to 40%. These are targeted, high active share funds deployed specifically into inefficient sectors. These satellites act as shock absorbers. They protect the overall portfolio during economic downturns, while seeking out returns that the rigid core cannot access. This structural blend provides the cheap, reliable engine of the index, while maintaining just enough active maneuverability to survive the new distortions of the modern market. The stock market has shifted from a series of human negotiations into a system driven by automated algorithmic flows. Blindly paying high fees for standard active management in an inefficient market is a guaranteed mathematical loss. Yet, blindly pouring all of your capital into passive indexes exposes you to dangerous new macroeconomic risks, including illiquidity and extreme asset concentration. A core satellite framework balances these two forces, allowing investors to exploit the efficiency of the machine while retaining the defensive edge of human logic.